Welcome, everyone, and thanks so much for joining us for our January State of Freight webinar. My name is Marianne Hensley. I oversee Sonar Marketing at FreightWaves, and we're happy to present today's webinar in partnership with BestPass. In this month's market update, we will provide a full outlook for Q1, including trends to watch, geopolitical updates, and more to help you plan for what's ahead. Today, as always, I'm joined by FreightWaves founder and CEO Craig Fuller and head of Freight Market Intelligence, Zach Strickland. We'll also have a live Q&A with our speakers following the discussion. Before we jump in, I'd like to cover just a couple of quick items. First, if you have any technical issues during the webinar, you can reach out to our team via the audience chat function in your webinar console. And if you have questions that you'd like to ask Craig and Zach, you can enter those through the Q&A box in your console, and we'll get to as many of those as possible following the discussion. We'll also be sending a link to the recording of this webinar tomorrow in case you'd like to view it on demand or share it with your colleagues. And at this point, I will go ahead and turn it over to Zach and Craig to kick off today's discussion. Great to have you guys here today.
Thank you, Marianne, and thank everybody for joining us today. A lot to get through. It's January, and we're pretty deep into a period of pretty recessionary feels in the transportation space. So Craig, I want to lead things off with kind of what your take is right now with the current state of the freight market. We really haven't seen any significant strong changes or anything that makes me think that we are, in the early stages or phases of some sort of transition. What are your thoughts there?
Yeah, it's a good question. I do think this winter storm that has hit, I think if you look at Q1 earnings, and a lot of carrier forecasts, they're going to mention it. Inevitably, anytime things are soft, they always blame weather. But I do think this is sort of a legit year. I personally can't leave my driveway. I've tried, and I'm stuck here on the mountain. That's why we're doing a non-studio version of this event. But I do think the weather is going to have a pretty big impact, both on the supply-demand equation. Whenever time we see a big weather event in the United States, it drives a lot of, it impacts retail demand for certain categories, and then sort of drives it. So we will see some impact of weather in Q1 as the country sort of thaws out from all of this. I do think we could see some additional demand that hits coming into February. So looking at the data right now, I actually think we're in this sort of really soft period in the freight market. One of the reasons that I think it's soft this week compared to how it's been in previous weeks is just frankly the weather. What's interesting is I have another small business that I run, which is called Flying Media, and we sell subscriptions and other products to consumers. We've seen a pretty significant dry up both in media traffic and in subscriptions this week, as well as our e-commerce business. It's largely related to what I think is weather. When people are stranded in their homes and doing things, it sort of takes away from some of that confidence that people have, as well as the fact that store traffic is going to be down due to these weather impacts. Having said all of that, I think I'm largely becoming more bullish on the second half of the year. You and I have talked about this, Zach, over the last, since we've been rehosting this, for the last 18 months or so. There's been a lot of uncertainty about when the market's going to turn around. I would argue that, I think the second half is actually going to be pretty good, largely because the capacity burnoff will, mostly be completed. If may have a little bit further to go, but I also think if the economy stays resilient, then I think we'll see a much more bullish second half of the year.
Yeah, I tend to agree with that. The outbound tender volume index here, we actually came out of the holiday, and I think that's one of my big takeaways is that consumers have been so darn resilient. They are stronger than everybody anticipated they would be, for good or bad, depending on how you view the debt levels and things like that. But tender volumes exceeded last year's levels coming into January, and January, February last year, arguably the bottom of the demand cycle for the freight market. We're falling down a little bit here. I think, like you pointed out, I think weather has a lot to do with it. Also, Martin Luther King week traditionally produces a little bit of a trough here. But I think, there is something to take away from the tender rejection index in the way that tender rejection rates, that, we came out of the holiday softer than we did this time last year. And now they've gone the exact opposite direction. So do you think this one is more weather related, or do you think that we've actually had a decent enough burn off to where the market's actually showing some signs that we've had we're going to be a little bit more sensitive?
Yeah, I think it's a good question. Certainly when you have weather issues like we've seen, you're going to have more rejections. Carriers can't physically haul the freight. They don't want to go into areas that are impacted by significant winter weather events. So, it's one that we need to watch. I think it's inconclusive at this point whether this is a short-term impact due to weather. As you mentioned, the holiday certainly has an impact to it as well. And so I think it's just a wait and see on where tender rejections trend. But, one of the things to keep in mind is that, like, we have seen over the past year that, these short-term impacts didn't really move tender rejections that much. Now we are looking at a pretty low base. And when you have a pretty low base, you can have more exaggerated moves in tender rejections, or at least we would notice them. I think it's more of a wait and see sort of, I think by the end of the month, we'll have a much better perspective on whether the market is starting to become imbalanced. I saw this as well earlier this week, noticed that it was trending up. One thing to keep in mind is that this is on a 7-day moving average. So not all of the weather has been truly sort of factored into this. I mean, we had storms last week in Tennessee and in the South. You didn't really have winter weather until starting over the weekend, and so for much of the country. So, like, at the end of the day, we don't have all of the winter events sort of factored into the tender rejection data, and so I think we need to sort of see how it trends at the end of the month. But I would say generally, I am positive, becoming more positive. There's a lot of reasons to think the capacity burnoff is underway in force. And, even anecdotal evidence looking at social media posts from drivers, they are starting to see better rate conditions than they have in compared to the last 2 years, at least in the spot market.
Yeah, I feel like that's right. Like we're in this near-term disruptive event of the weather. Obviously, the temperature drop too has a big influence. We've seen tender rejection rates increase meaningfully out of Chicago. They're used to snow, so it tells me that we have had some semblance of a burn off in capacity that is meaningful at this point, because haven't really
they're used to snow, but we're talking about pretty severe temperature, the impact. I mean, you can look at the
21 where Taylor Swift was last week.
Yeah, I mean, the Chiefs game was a great example. I think it was the second or third coldest NFL game to ever be played in history. And there were times when, you look at the Green Bay Stadium and just how freaking cold Lambeau is. Why do people go out in that kind of freezing weather? When they could watch it on TV, but it's part of the tradition. So you think about the perspective of Kansas City being, one of the coldest games in history,
right,
is just sort of telling about how severe that was. So I don't know that it's fair to sort of say Chicago's used to winter weather. I mean, we saw a couple of years ago when we were hosting our event in 2019 for FreightWaves, our Transparency 19 event up in Chicago at McCormick. I mean, that shut down O'Hare in the middle of November. And so, or I think it was even early November. So there is, yes, Chicago certainly is used to it, but I don't know that I would compare this winter event to this sort of traditional weather events. This one has been pretty dire and pretty cold. But having said that, I think the question is, do we believe that the capacity burn-off has happened? Do we think it's still underway? I think certainly the worst of the market is behind us. I think we will look back in 18 months and maybe in years to come, and we will say that May of 2023, so that mid-May drop was the low of the market, and the cycle began there. But it's going to feel a lot like that 2009, 2010, 11, 12 period, where this is a much slower build, I think, sort of out of the gate. But there will be an inflection point.
Yeah. So, I mean, to that same point, I mean, again, we're kind of beating the capacity horse a little bit here, but this is
we always do, because if you don't, Zach, that is the question, right? What happens to the market and capacity? And so I think you have to answer the capacity question. If you don't answer it, you're not fully addressing the problem.
Yeah, so let's talk about this one. So carrier details, net changes in trucking authorities weekly did exactly what we kind of thought it would do: accelerate over the holiday period, kind of that exit strategy here, where everybody leaves, they park their trucks, and they're basically done because they know January, February traditionally not great. Also, it's the holidays, going to spend time with their families versus getting in the truck. Just a good jumping off point. So what I found interesting, though, is that last year, and well, not last year, but 2022, we actually netted almost 17,000 new authorities in 2022. Keep in mind that we, of course, the market turned dramatically in 2022, and most of that year was spent in what we would probably consider a freight recession, with rates coming down, oversupply, et cetera. We lost 23,000 authorities in 2023, according to this chart here. So big shift. Do you think?
But keep in mind, if you go back to where we were in September of past year, August, September, we were still up 68,000 authorities.
Yeah.
So 23,000 even, and that takes in the full year. There was perspective that maybe we lost 7 to 15,000, depending on, and you may have more updated numbers, but there's still a substantial amount of capacity that's left over that had not burned off, and it's not burned off. One of the things I was talking to a well-respected Wall Street analyst this past week, who, not to sort of steal their thunder, because a lot of times we have these conversations on background with sharing thoughts, but one of the things he pointed out to me, and he understands the cycle incredibly well, was that he doesn't believe that the capacity burn-off answers all of the questions about the market. He actually thinks that's overrated in terms of the conversation. I don't know that I necessarily agree with him. His argument, and I think it's actually a sound one, is that capacity doesn't ever leave the industry. It just gets recycled and moved. And I actually think it's a pretty smart concept in the fact that, trucks typically are not being removed from the market. They end up in different parts of the market. You have to export the trucks really to kind of get rid of them. So that's one aspect of it. Drivers do enter and exit the market, but as the market heats up, more capacity enters. And so his thing is always a demand-driven question, is how much is demand driving this? A different sort of thought than what you and I have sort of shared. We've been able to explain the freight recession through excess capacity, but I don't know that every question from his perspective is answered through a capacity burn-off. I actually think there's a lot more to be said on the capacity burn-off question. I'm not as negative to that thought as perhaps he was, but I do think it's interesting because we've talked a lot about capacity burn-off. This chart is a great example of that. But one of the things I think we should dive into is demand, because I think it's actually a really important factor. You and I haven't spent a ton of time talking about the demand part, frankly, because I think we were so bearish last year for much of the year that we kept thinking that the collapse was sort of inevitable, whether we looked at consumer spending, student loans. Really, the demand side stayed robust. I think you commented to me in gosh, it was November, December, probably it was December, that if you took 2023 and you removed, late 20, 21, and 22, 23 was actually a pretty good year in trucking. And really in fact, some of the people who have attacked the concept of a freight recession had made that argument that you don't have a freight recession when you have higher volumes. And it's a fair statement, because the word recession isn't well defined as in terms of freight, but it's also, like, let's be honest, the White House and I think the National Bureau of Economists, or whatever the name of that organization is, redefined the term recession during COVID. So, like, ultimately, but at the end of the day, the question is demand. And I think one of the things that I'm really encouraged by, and this is one of the reasons I've become more bullish in sort of the second half, is there's a lot of great things happening. Inventory burn-offs are happening. We do know that that's taking place. We are, 2 years into the freight recession, which I will call what we've seen the freight recession, regardless of the debate. Being 2 years means that companies have had a chance to adjust. We're into a second year of the routing cycle readjustment in rate, which means contract rates are largely going to adjust this cycle to more of what the market clearing price is. We've seen companies not be aggressive in hiring drivers and not adding equipment to grow their fleets. The equipment additions and the have largely been not net new, but just getting rid of older equipment that they held on during COVID. We haven't seen a lot of aggressive driver campaigns to hire new drivers that we saw a couple of years ago. So I think largely those things are all positive. And then as we look at the demand side of it, you have so many things that give you reason to be bullish. Consumers have stayed pretty robust through the cycle. Even though Biden didn't get what he wanted in student loan cancellations,
right.
Initially, he's found ways to sort of backdoor that, which has helped out some consumers more so. The job market has stayed incredibly robust, and government stimulus, not in the form of consumer handouts or business handouts, but government stimulus in the form of infrastructure, the Inflation Reduction Act, the Build Back Better plan under Biden has pumped so much capital into our economy and it's sort of hidden money. Like if you think about it, this money takes a long time to cycle through, and it's sort of hidden in the sense
that there's a delayed, impact from the ERC that hit.
Yeah, well, the ERC, but also if you look at manufacturing back into the United States, a lot of that is, we talked about this last time. I sat down with the CEO of one of the world's largest car manufacturers, 2 months ago, and he pointed out that the amount of money per auto manufactured is in the billions of dollars of incentives. And he's like, look, EVs are coming whether consumers ever buy them or not, because auto manufacturers have so much money available to them to take, build plants here in the United States, whether they're battery plants or EV plants. They're going to build these electric vehicles. And because the government is providing so much funding for that.
Right.
So construction and manufacturing is coming back. It's a reason to be incredibly bullish. And then we have to talk about the Red Sea and sort of this geopolitical issue that's taking place. One of the things that I read something this morning was that, and I think this makes complete sense, is that, the United States is more immune to the flow of freight through the Red Sea than Europe is. It's largely a European lane. But we still do receive freight that has historically gone from the Suez. But what's actually shifting now is the fact that a lot of that freight is going to go to the West Coast because of the Panama, drought, as well as the Red Sea. And as it shifts to the West Coast, then that means you'll see more domestic and surface freight demand that will really provide some level of support for the freight market. I mean, one of the worst things for trucking is that freight flows into Newark because
right.
you don't have these long haul sort of lanes, but flowing it into LA and Long Beach is actually pretty bullish for surface freight, both intermodal and trucking. So those things are good. And then look, when we have geopolitical issues like we have in the Red Sea, you're going to have supply chain decision makers that are saying, I need to think about sourcing freight from the Americas. I don't have to deal with state-sponsored terrorist attacks on my supply chain if I'm manufacturing and supplying in the United States, I'm holding inventory in the United States, or if I'm sourcing in places like Mexico and Colombia. And so because of that, I think we'll see more just continuation of this sort of reversal of the trend of sort of globalization.
Yeah, so this is the chart that's outlining the spot rate from China to North America's east and west coasts and the spread between the two. And of course, the more expensive it gets to ship something to the east versus the west coast, there's a natural tendency for shippers to bring stuff back into the west coast. The bigger that spread gets, that blue line there on the bottom that we call affectionately the Panama spread. And I've talked about this a few times in the past in the way that because Los Angeles, Southern California is actually in the middle. It's an oasis of freight in the middle of a desert of freight. And so when trucking carriers or service providers are forced to navigate getting trucks into an area these are 2,000 miles of nothing. The mountains are great to visit, but they don't produce a lot. And so when networks are forced to service Southern California more so, it spreads their network exposure. And I think that's what you're kind of, really hinting at here is that
it's a really important
the more
fact.
freight that comes into that space, the more stretched networks become.
It's a really important point. And a lot of carriers, with the exception of the owner-operator population and the intermodal carriers, but the long-haul truckers, when I grew up in trucking and I was, a young boy in the trucking industry as a trucking brat, the long-haul market that California, there's really two long-haul markets. It was the north-south lane, which was largely automotive on I-35, and there was that west to east coast lane that was really I-20 and I-40. And I-10 was a little bit of it, but really that was the big freight corridors. And largely what we've seen is this, a lot of the bigger carriers have exited the California west to east market and have really moved away from long haul trucking. The owner operators and a lot of the spot driven folks, really that's where they make their bread and butter. And so you point out an important fact, no different than what we see on the Red Sea is when you extend the distance traveled, you're just taking available capacity out of the market. And one thing that you and I haven't talked about, and I don't know why we hadn't, but I don't think it had, and at least it hadn't occurred to me, and maybe you had thought about it, was as freight shifts to the West Coast from the East Coast, is you're actually increasing the amount or decreasing the amount of available dispatchable capacity because you have longer distance to go. The other thing is, like, as you move it to the East Coast, just shorter distances, period. I mean, if you go into Newark, a lot of the consumption that happens in Newark is on the eastern seaboard anyways. And so as we see freight moves to the West Coast, you will see some level of sort of capacity reset, particularly in the spot market. And I think that's an important fact that we should be thinking about that perhaps we haven't talked a lot about.
Yeah, we may not have talked about it, but I know that we've written about it several times in the way that I think a lot of the concern was, after the pandemic, a lot of shippers got used to shipping stuff into the East Coast. So it kind of pulled everything east, which is focused on a shorter haul freight that doesn't disrupt capacity near as much. With the Panama Canal drought situation down there and now all the geopolitical struggles that are occurring, we are now in an environment where, and I think naturally people were starting to ship things back into Los Angeles just because it's easier. And now everything else kind of compounding that, reversing all of that trend of that shift to the East Coast has now become almost gone, like almost completely eradicated. And with all the risk in it, you can't really fault them for doing that. Do you think that this, LA's kind of, it's not the time of year for Southern California freight, and it has kind of fallen off. But I do think that, like you said, later in the year, when that freight starts kicking back in, because inventories have largely corrected now.
Yep.
So it's almost like kind of a ticking time bomb potentially, especially as capacity exits. And I do like the thought about demand. I'm actually a big proponent of thinking about demand monitoring being a little bit more important than capacity monitoring in regular times. Now is more of a capacity oversupply. But as capacity erodes, it erodes very slowly compared to demand's potential movement. So all it takes is, as capacity erodes, and that's one of my next questions is, since capacity does erode slowly, it's almost like a big, huge truck or train in terms of momentum. It continues to erode, or it builds, but it's slow and it's hard to stop. So it will continue to erode through a period, especially if we have a spike in demand. Do you think that we're at more risk for, the market really having significant disruption because of that influence of slowly eroding capacity, not recognizing or shifting direction in response to demand?
We've seen this play out before. I mean, if you remember, back in 2014, you had a robust market, then 15 collapsed, 16 was a really soft market. And then we had the hurricanes and just, ELD mandate that was coming into effect in sort of late 2000, August, September of 2017. And we saw how great 2018 was. So we have certainly seen the market surprise us. I think the question is really a demand question. I think, to your point, capacity is going to continue to erode. I mean, the balance sheets of carriers are not great. You always see a situation where capacity is well behind, the supply is well behind the demand factor. I mean, demand pulls on this market, both on the upside and the downside of the market. So demand is what effectively drives the supply. And so we will see, I believe, supply continue to deteriorate well into the demand reset. And as we see demand come back, or increase, I should say, then I think that's a really positive development for the overall conditions of the market. A couple of reasons I have started to become more bullish is we talked about geopolitical risks that change the supply chain, the freight map. West Coast is a really positive thing for freight and freight demand for the reasons we've highlighted. The second sort of factor is that manufacturing through government stimulus. So this is the largest government investment in manufacturing since the Cold War. And in fact, even bigger in dollars. This is a massive military industrial complex style investment, not to mention military investment, period.
Right.
One of America's great industries, whether you like it or not, is
biggest
defense.
Company in the world. Yeah.
Is defense. And, there is not a lot of political appetite to cut defense spending, regardless of who's in office.
Right.
And so we will see more money being spent on defense as these geopolitical pressures happen. And one could argue we need to spend the money because we clearly don't have the either appetite or resources to defend the entire waterways the way we did. And so because of that, there's going to be a lot of pressure to spend money. I think in the next political cycle, as we're going into it, I think we'll hear a lot about, even perhaps Trump will attack Biden for not protecting the seas because it's clearly a level of vulnerability and geopolitical vulnerability. So we could see more spending towards military and defense that will drive a lot of demand in the U.S. We see this automotive development, semiconductor investment that's happening. And then we see in the background, probably even a bigger story that isn't appreciated as much is supply chain professionals that do this for a living are really in the risk management business at the end of the day.
Right.
I mean, effectively, the reason a supply chain manager's role has been elevated in companies and sort of really historically, but certainly in the COVID cycle, is to ensure products flow. I mean, if products flow successfully, a lot of this stuff could be managed through computers, but they don't. And you deal with disruptions, and the people that really make the money in this space are the ones that know how to manage risk, deal with the exceptions, but also think about risk management. And so we're going to see a lot of emphasis on reshoring, remanufacturing into the United States, into North America, simply because the risks are too big. And I would point out one thing. You have to believe that, container shipping out of China is not currently disrupted as it flows to the West Coast. Like, we're not seeing those ships be attacked. But you have to believe in China that Chinese military planners are watching what's happening in the Suez and taking note and thinking about the fact that there is a very low-cost way to disrupt Western-bound freight and supply chains. Is think about the fact that the rebels are spending, these drones are a couple $1,000s to less than $100,000, that they're able to attack ships in ways that we've never seen happen. You don't have to have an airplane or a cruise missile to put pressure on ships. And so we will see a situation, I believe, where the risk of moving freight through containers becomes exponentially higher, and insurance companies will take note of this as well.
Yeah, because container shipping has been relatively cheap. I think what's fueled most of our economic growth from a consumption standpoint has been the fact that we could source goods cheaper and bring them over from long distances relatively cheaply. So
it's helped from an inflation, certainly has lowered the cost. I mean, Walmart's entire business model has been sort of arbitraging the cost of producing in China and sourcing manufacturing products in China, lower cost consumer goods, and driving down costs by really arbitraging, encouraging manufacturing to come to China, really sort of support that and bring those products to help consumers save a lot of money. And that has worked really well. Amazon is largely doing the same, and Amazon suppliers. So that arbitrage is going to become more difficult in the coming years because global shipping is less dependable, potentially, more expensive. Like, go back to the chart where you had the West, I don't know if you have it on your chart, but the West Coast United States, China to the West Coast US. Those rates are also surging, right? Like there is no tax on West Coast bound ships.
Yep.
But the reason that's happening is twofold. It's the same thing we talked about in North American trucking, is when you add distance to a voyage or a transportation, you add distance, you take available capacity out of the market. So that's the first thing. And the second thing is a risk premium. Insurance companies are increasing the cost of global shipping, of what they put on the global container lines. And the fact that the container shipping companies are putting a risk premium in on their own business because they can do so in this climate is reasons that we're seeing a lot of these developments.
Yeah, and then just to put this in deeper context, so the white line on the previous chart, spiking, it looked very aggressive, and it is. But compared to where we were in the pandemic, so this is the spot rate from China to the Mediterranean in white. You can see over the last 5 years, we had the pandemic influence. And then you see the yellow line is China to North America's West Coast, the spot rate for a 40-foot container. And on the other chart, it looked pretty aggressive, but we're still nowhere close to where we were. And of course, obviously, this influences the Mediterranean region a little bit more aggressively. That almost looks like a pre-pandemic or an early pandemic spike.
I think it will be. I mean, Zach, I think, moving products to Europe is just becoming more expensive.
Yeah. Well, Rachel Premack wrote an article about how we have become so accustomed because we had this extremely long period of stability from a historical perspective, geopolitically. And now that's kind of eroding, and that's disrupting this space potentially more so, which will have a downstream impact on trucking, as I think your point that you're trying to make is. But do you think that this is going to be, I don't know that this is going to go away this year, even if
it's not. Look, Peter Zeihan's book, I highly recommend it. So if you don't know who Peter Zeihan is, we had him at our event a couple of years ago. He's got some great YouTube videos, but he's been really on this topic about how, because the U.S. Navy has protected global shipping lanes for the last couple of, really since World War II, we have benefited, and China in particular has benefited from that U.S. protection, the U.S. Navy's willingness to protect global shipping. Well, those days are likely over with. And I think because the U.S. Navy, A, doesn't have the resources, and B, all of the attention is on China, I think we're going to see a situation where the sort of protection of global shipping, and let's be frank here, this is a tax on the American economy and the American consumers in many ways, American taxpayers, because we're paying for the protection that we don't benefit as much as Europe and China do. The two primary beneficiaries of global trade and globalization are China and Europe, because Europe doesn't have the manufacturing base in its own continent, or the resources, or the labor supply that we have in other parts of the world, the energy supply. And so it is in a situation where it's much more dependent upon trade to support its economy than other parts than the United States arguably is. And so when we look at the advantages that we have in the US for manufacturing, the need to move production offshore just isn't as attractive as what it was a couple of years ago. The other factor that's in this, and this is pointed out in Zeihan's book, is that the cost to produce goods in China has gone up exponentially, something like 10x in the last 10 years. It is now more expensive to produce products in China to manufacture them than it is in Mexico,
right?
Vietnam, Colombia. So we're seeing a situation where that China arbitrage discount just isn't there. And so I think what's going to happen is that the appetite to protect sea lanes is just not there. These container lines are not owned by American businesses, American companies, period. And so if you think about it from a sort of political standpoint, Donald Trump can easily say, hey, I'm pro-protectionism. We know he wants to bring manufacturing back to the United States. Donald Trump, for all of the things he got, has been all of the sort of craziness that we lived through in terms of all of the sort of noise and drama that is the Donald Trump presidency, regardless of where you sit on that, did not go and fight wars and was not using our military to sort of protect U.S. global interests the way other sort of administrations have. So you could largely expect that he is not going to protect global shipping, regardless of the fact that there's a vulnerability in the election for Biden. And I think what we will probably see is a hands-off sort of approach. And this is what Peter Zeihan says, is that ultimately Donald Trump is an inevitable candidate because we're in a whole new generation where American protectionism is real. Make America great, using Donald Trump's quote, is not just a Donald Trump sort of statement, but it's even Biden's trade policies have largely followed the Donald Trump playbook. Biden has not reversed any of Donald Trump's trade policies. And so if you look at that, we're going to move back to more American and American sourcing. There's less appetite to source products in other parts of the world than there were before. Supply chain managers have got to consider these issues. And then you have all of the sort of call ESG related issues when you talk about global sourcing, which includes environmental. I mean, China's environmental record is trash. And so I think we're going to see situations where consumers demand more visibility and transparency in supply chains, and therefore are going to want to see sourcing in parts of the world that don't have such a bad track record for environmental. I mean, producing goods in the United States, because of our environmental, for better or worse, it's more expensive, but it's also consumers feel more confident because we have better quality rules than they do in China. And so because of that, I think we'll see more manufacturing move here. And I think we're not going to see the trade lanes protected by the U.S. Navy than they were in the past. And frankly, all the attention is on China right now. I mean, look, I'm not going to say that this is the right decision, but you have to wonder at what cost are American consumers and American politicians ultimately going to be willing to let our dollars at $1 million a missile, or whatever it is to defend these ships, continue to happen when we are not as big of a beneficiary as some of the other parts of the world.
Yeah, so one of the things I want to call out here is, yes, I think everybody is very aware of the nearshoring movement and things like that. This is the inbound ocean TEUs volume index from China to the United States. You can see the white line there in the very beginning of this chart is well above where it was this time last year. It's below the end of what I would consider the pandemic era, which is not
Sorry, I'm at home and my 3-year-old has gotten stuck in my office. So hang on one second.
So I'll talk through this a little bit here. So demand side factors. So the demand side influence hasn't really manifested yet. What do you think this year is your opinion on what's going to happen? Because right now, everything's still coming from China. How is this going to manifest domestically in the United States this year? I know we can't replace China overnight, but do you think that this is going to significantly be down? Do you think we're going to be down next year outside of I think you can call that last part of the green line there and the early part of the blue line, kind of that inventory corrective influence. But now that we're out of that, do you think this is going to go down kind of organically?
I don't know that it's a down. Like, you can still have growth in Chinese container imports and move away from this concentration of China. Mm-hmm. And what I mean by that is there's a market share development here. You look at the share of Mexico in terms of its trade lanes, India, Vietnam, really since 2018, we've seen a lot of diversification away from China. China still grew. I don't necessarily think that you will see a situation where we'll see a dramatic drawdown of products out of China, because there will always be some level of manufacturing there, regardless. And China will continue to play an important role. But I do think we'll see a situation where we will see higher concentration of freight and manufacturing from Mexico to the United States, from Canada to the United States, from Colombia to the United States. I think actually one of the interesting countries that should be on your radar is Argentina. I mean, the new president of Argentina is, he is trying to stabilize his country, liberate the economy. And we've seen this play out in Latin America periodically, where countries all of a sudden go from really tight socialism to really sort of progressive, libertarian type policies. And we see robust growth. I mean, Colombia has been an amazing sort of story since it got its act together, in the mid 2000s. It all of a sudden has become a really sort of powerful economy in Latin America. I think potentially Argentina in the next decade maybe could get there as well if it sort of gets some of its structural stuff fixed.
Yeah, I think it is going to be interesting to see how this geopolitical strike. I think obviously the sentiment is that things are going to be brought closer to home. Do you think that creates, this deglobalization, which seems to be the theme of the last year and a half post-COVID? Do you think that creates some challenges, though? Like, I know we're talking about the freight kind of moving in. What are the challenges that come out of it?
You have labor supply availability. I mean, you have environmental and permit regulation. Americans love to regulate permits. And I'm doing a real estate development, and we're 2 years into an environmental approval from the Army Corps of Engineers. And so there's a situation where this is just a part of Americans' fabrics of overregulation. I think that's the risk, is that we stunt our growth. We have very little labor supply, excess labor supply, but certain industries like semiconductors and what's happening in Arizona, fabrication plants are coming back to the United States. We're seeing electric vehicles and battery plants that we discussed. Those things are incredibly bullish for freight demand. Housing looks like it could bring a lot of promise to the second half, and housing is largely a domestic sourced for the predominance of freight demand.
When housing blows up, so does freight. Yeah.
And so all of those things are really positive. And one of the things that I'm sort of thinking about a lot is we may see exporting from the United States to Europe as the Suez becomes more contested, because they will start looking at Mexico and the United States. I mean, the thing about Europe is not only does it have a labor supply problem, a regulatory framework that isn't progressive for manufacturing, but you have no energy supplies to speak of domestically in a lot of those countries. And the United States is abundant. Like, the amount of oil and fracking and nat gas that we have in the U.S. puts us in an incredibly great position for rebuilding the manufacturing. Mexico is also a beneficiary of this.
Yeah, for sure. Well, I know we've got a lot of questions, so let's go ahead and divert to that, Marianne, if you want to lead us off here.
Absolutely. And thank you guys, as always, for the excellent conversation. If you all have not already, be sure to enter those questions into the Q&A box, and we'll get to as many of those as we have time for here in the last 15 or 20 minutes or so. First question for you guys. It says, a big unknown is the election and the impact an election year will have. Will investors get excited if Republicans have momentum? Will another crazy virus come out of nowhere? Riots and looting always happen during election years. No one seems to be talking about this. What are your thoughts?
I'm so glad the easy questions are being asked earlier in the conversation. Look, these are all, the election is not a black swan event. A COVID-related virus is a black swan event. Rioting, looting, we'd like to think is sort of a black swan event. There is certainly the social divide is a real factor. But even when we had the riots in 2021 under, the George Floyd sort of instigated riots, or the issue with, in terms of what happened in the summer with what happened to George Floyd, that didn't change the freight map that much. We didn't see a lot of issues with it. There were certain parts of the, particularly urban centers were I think Minnesota was sort of ground zero for that. We've seen St. Louis become ground zero in the past for these types of situations. It didn't really impact the freight map whatsoever. And so I don't think that social riots and tensions really cause an impact to freight and supply and demand issues. I think the political cycle and the election is a real issue. Who wins that election? I don't do this for a living. I'm as curious about listening to the folks that that do this and study it. But look, a large percent of the country, regardless of where you stand, is going to be unhappy. I mean, I think Donald Trump's only has like a third of the 30% of the people are pro Donald Trump, and Biden's even less if you look at the stats. I mean, they're almost neck and neck of non-desirable candidates. So that argues that 70% of the population will be dissatisfied with whomever we elect. So you could see some issues after the election, but I don't know what that means from a sort of a problem in terms of freight demand. I just don't. To me, it's a factor that I don't even know where to start.
Yeah, there's too many potential outcomes there that we can't predict, and I don't think anybody can. I think what the takeaway here for me is that regardless of the outcome of the election, we're in a period of increased volatility, economically speaking. Geopolitically, the world is a little bit different. It's more chaotic. We're more prone to disruptive events such as rioting and things like that, and people being very opinionated and very strongly moved to do things and change their behaviors nowadays. So that's what I take away from this, is that it's not that whatever the outcome of the election or another virus or whatever is, it's that we need to be, I think, more mindful of the fact that these periods of stability are actually the anomaly, and the periods of potential fluctuation, we now have to be more thoughtful about knowing that there's going to be disruption.
Yeah, absolutely. Look, I think regardless of who wins the election, it looks like it's going to come down to one or either candidate, Biden or Trump, short of a black swan sort of candidate that sort of emerges, that takes momentum. I think reality is that government deficits are here to stay. I mean, Trump had no problem spending money. Biden has no problem spending money. They spend it in different ways. Trump, likes to cut taxes and do things that, stimulate parts of the economy. And Biden likes to spend money on sort of these big, sort of reshaping the way America's manufacturing economy works. And both of those things require some level of spending, or a lot of spending. So I think, and we're going to see more American protectionisms. Clearly Donald Trump is, anti-globalization. I don't think that's a controversial statement. Biden has also largely anti-globalization. Like, he may be a better statesman internationally than what Donald Trump is, but he has certainly done nothing to reverse Donald Trump's trade policies. He's just been a lot quieter about it. And I think because of that, we're going to see more manufacturing development in the United States. We're going to see more deficit spending. We potentially, if Donald Trump gets elected, we'll see tax cuts, which will stimulate the economy. If Biden gets reelected, I think we'll see more spending on some of this sort of reshaping, electrification, and decarbonization of our economy. But regardless of that, I think we're going to see more spending, more deficit spending, which is just going to drive demand.
Awesome. Thank you both. Next question. With respect to capacity moving out of the market, is there a split between truckload and LTL?
Well, LTL, because of Yellow's exit in the market, I mean, LTL is largely a more disciplined market anyways. The barriers to entry to grow capacity, it's a far tighter market, a far more rationalized market, just fewer players that end up expanding capacity. Yellow leaving the market as big and significant as it was probably the right time for it to leave the market, because the market had largely was able to absorb all of that demand. But the sort of backstory of this, to your point, or to the question, is it was able to absorb it because the market was incredibly weak. As the market heats up, we could see LTL run out of capacity relatively quickly. One of the things that I think is also interesting is that LTL does really well, not necessarily stock prices, but it does well as certain parts of the economy turn back on, because the shipment sizes aren't as big. And so it actually benefits from sort of the parts of the cycle where, until we get to, these bigger shipment sizes, it actually does well. And so it may run out of capacity quicker, and we may see some flow more into the truckload sector.
Yeah, LTL always follows truckload, though. The markets are very closely tied together. I think LTL got a gap stop with Yellow's exit. We were seeing that space start to feel the effects of the truckload recession, and then Yellow's situation kind of stopped that from happening. We have seen rates stabilize, and they're not going up as much as they were, but I think at the end of the day, LTL is a much smaller segment, and so also much more resilient to these cycles in terms of up and down, downward movements, because they're just more stable. There's much less competitors in there, and the market itself is just not as erratic, and it takes a lot of energy.
LTL has more ties to the industrial economy than truckload, or as a percent of it, and so it's going to benefit from a lot of this, reshoring that we discussed, and sort of these infrastructure investments and remanufacturing. As LTL will have an outsized benefit from those factors versus truckload, which tends to lean itself higher into consumer consumption and things like CPG and retail than what LTL does. So we're going to see some factors that benefit the LTL business more so than truckload, outside of just the fact that it's a more rational market.
For sure.
All right. And next question here. With health and trucking insurance continuing to rise 25% or more year over year, what is the best approach when pricing bids to help justify the increase in cost while remaining competitive to get awarded more revenue?
God, these questions just get more interesting. It is a great question. I think, frankly, the only way to get more revenue is the market has to support it. I mean, the reality is you can certainly try to make the case to shippers that, you're having higher costs in drivers and higher costs in insurance. Shippers, are going to be certainly responsive to that only if they feel like capacity is in short. Because this is a market level issue. Insurance is a real problem for every trucking company in America, some more so than others. The reality is that shippers are hearing it from everybody. But if your competitor, who's also facing the same challenges, is willing to take freight at 10 cents a mile cheaper than you are, they have the same challenges. You can bet that a shipper is likely to pick that carrier over you if they felt like capacity was not going to run out. So from where I sit, you have the short-term bid aspect. If you buy into the fact that we'll see a second half recovery in freight conditions, then you should be thinking about timing your bids appropriately to sort of deal with that. You can offer some, incentives to shippers short term, but just tell them, hey, this is a short-term rate. If things do turn around, then I may be rebidding it. And assuming you can get away with that, because not all shippers will support that, that may be the way to handle picking up some volume for the first half, and then knowing that you may give some of that volume back in the second half.
Yeah, you said it perfectly. The market dictates how you can price your bids. I mean, that's it. If the competitor can do it, then that's just what you have to deal with, because they're burdened by the same exact components of that. I don't know that I have any additional thoughts or anything on that, other than you really are just going to have, like, the costs themselves are what they are, and you're going to have to give somewhere if you want to get more competitive. So it's just a difficult situation. It's a challenge. You're going to have to bid for resilience in some areas, take advantage of backhauls when you can. and that's your competitive advantage in a space like this, and just try to make it to the other side.
Survival is key.
Yeah.
I mean, at the end of the day, you can hold out for higher rates as long as you want, but if you don't survive to see the other side of it, it's sort of a pointless exercise, and no one's going to care.
Yeah,
don't be a hero. You just need to survive, and that means keeping your trucks loaded when you can, keeping your drivers on staff, keeping them moving, and ultimately you just have to sort of survive to get to the other side of it. I mean, brighter days are certainly ahead, whether it happens in the second half of the year or happens in a year from now or happens 3 years from now. Brighter days are certainly ahead. So if you can hang on for hopefully a couple of months, my theory is that you'll see better conditions in the second half. But right now, it's just all about survival. Keeping those trucks running, keeping those drivers moving is going to really help you win and prepare you for the second half.
Awesome. Thank you both. Next question here. It says, why is demand supposed to come back given that economic growth is supposed to slow in 2024 versus 2023? He says, we've been talking a lot about long-term things like reshoring, government stimulus, geopolitics, but cyclically in 2024, why is demand going to return?
Yeah, I don't know specifically what forecast the questioner, person asking the question is looking at. There's a lot of sort of different sort of points of view on what the economy will do. The growth rates are certainly likely to slow. I think this is a consensus view on Wall Street, that the growth rate will slow. But I had not heard a lot of conversations in recent months about a recession happening in 24. I mean, there is conversation about it, but I think a lot of the major firms on Wall Street have sort of discounted that. But there are some real developments that I think you have to look at. I mean, you see things like inventory bleed off, which is what really caused a slowdown in freight demand in 22. That is largely bled off. That will drive some restocking, particularly we're 2 years into it. That's positive. We've seen capacity bleed off. That's going to help just the natural supply and demand balance in the market. As Zach and I talked about geopolitical, this is a short-term impact. Moving freight from the East Coast to West Coast is a pretty instantaneous, maybe it takes a couple months to complete that, but it's an almost instantaneous transaction that will play out this year. That does take a lot of available capacity out of the market. And so those are real factors that will be short-term. You are correct to say that, nearshoring and reshoring are long-term facts. These are decade-long developments in some cases. But there are some short-term reasons to be bullish. And that's why, from a demand side, that I become more bullish.
Yeah, I think too the fact that we've seen it demand has defied expectation. So for me, it doesn't happen until it happens anymore. And right now, when I'm looking at the OTVI and the IOTI and the other demand side indicators, there's not a sign that we're seeing a slowdown. And it's January. I mean, other than the seasonal norms. It's hard for me to say that I know better, considering that it should have already slowed down, and it hasn't. And everything you said.
Factors that I think we should talk about is, remember, a lot of the GDP growth has been services, travel, entertainment, restaurants. So that post-COVID world, things we couldn't do for a couple of years has seen pretty robust growth. The goods side of the economy has actually been pretty sluggish relative to how well the services side of the economy has done. And so we could see some rebound and a reshaping and reconfiguration where goods demand, because of inventory shortages, come back. I know consumption in my household, just in products, we went from, after COVID, we almost had no appetite to order anything when we were out and our money got allocated to travel. Some of the stuff that we bought has started to age, and we're starting to spend, some more bigger ticket items that we haven't bought in a couple of years because we have sort of absorbed all the things that we consumed during COVID.
Yeah, so electronic growth, which died for about a year and a half after everybody got released into the world.
Well, one thing that I learned in aviation is a lot of the R&D cycle, like think about movies, think about automotive, airplanes in this fact, electronics, a lot of that died during COVID because people were not producing anything. R&D was shrunk in terms of new product designs. But you can look at the CES reports to see some of the new types of electronics that are coming back. Some really exciting things because we're now past that R&D. The R&D we're sort of 2 years into it to sort of the resurfacing of R&D. That could drive some additional consumer spending because now people are thinking, hey, it's time to think about replacing some of the stuff or adding some of the stuff because it's got some newer features.
Yeah, it's like the COVID boom for electronic purchases.
All right, everyone. It looks like that is all of the time that we have for today. So thank you all so much for taking the time to listen in. Thank you again to our partners at BestPass for bringing you today's presentation. And of course, as always, thank you so much to Craig and Zach for the conversation today. One reminder, don't forget to join us on June 4th and 5th in Atlanta for our Future of Supply Chain Conference, where we will be showcasing the latest tech, a lineup of amazing speakers, and of course, all of the energy that you've come to expect from our events. You can get your discounted tickets today at live.freightwaves.com before the price increases on February 1st. Thanks again for joining us, and we hope you will join us again next month.